You are not losing money because you are unlucky. You are losing money because the system is designed so that your losses are the business model. And here is the part nobody wants to say out loud. Most people never choose between investment and gambling. They choose between two flavors of the same trap, and one of them is politely branded as normal investing. This is not financial advice. This is financial education, and it is aimed at one question. Why, in 2026, after all the headlines about AI, after the housing crisis, after the inflation hangover, after the endless market highs, do average people feel poorer every year? You are going to learn the difference between investment and gambling in a way that actually survives contact with reality. Not vague motivational definitions, real mechanisms, real incentives, real probability math, and real examples from the last decade, including the stuff that hurt regular people when they followed the script. Because if you think money is random, you will behave like a victim when it stops working. And if you think the market rewards patience, you will learn the hard way when patience becomes too expensive. The first lie you were taught is subtle. It sounds harmless. The market rewards the long term. The second lie is more aggressive. Just buy something solid and stop worrying. The third lie is the one that keeps people trapped. If it feels too risky, you're probably doing it wrong. In 2026, those lies collide with a new enemy: AI. Not because AI is evil, but because AI is efficient, and efficiency destroys the old middle. The jobs that used to buffer the gap between entry level and stability are shrinking, and the people who used to climb are being forced into a life where one bad month wipes out the savings they were counting on. So let's start where the truth is simplest. Probability. Incentives. What you are actually trading. Picture a crowded street. Left side of the street, a stall operator smiles and says you can win easily. Right side of the street, another operator offers a game that looks identical. Same crowd energy, same bright signage, same promise of quick wins. You toss in $1. On the left stall, if you win, you get $53 back. On the right stall, if you win, you get 50 back. At first glance, the left stall looks like the clear winner. The payout is higher. The math feels better. It even sounds fair. But now listen carefully, because the difference is not the payout number. The difference is what gets removed from the deck. On the left, the game uses a full standard deck, including the cards that pay out when you match the drawn card. The rules are that your selection must match a randomly drawn card. It sounds fair. It sounds like you just have to pick right. But the business side is the truth nobody posts in big letters. Over time, if the game is built to make money for the operator, your expected value is negative. Not sometimes. Not in the short term. Over time, you can win early. You can even win big early. That is how they keep you there. A lot of people confuse "I had a winning streak" with "this is a good game." That's like confusing adrenaline with health. Early wins are bait. Now the right stall looks worse at the payout level, 50 instead of 53. But the operator does one thing that changes everything. They remove two cards that would have favored you, and they remove three other cards that would have made your chance higher. They don't remove them loudly. They don't put a sign in the window. They just make the deck different. And suddenly, the game is still a game of chance, but the operators stack the odds. This is exactly what distinguishes investment from gambling in real markets. Not vibes, not branding, not how educated the people around you sound. The difference is whether the structure gives you a statistically meaningful advantage or whether it monetizes your participation. In gambling, the advantage is built for the house. The math is designed so that your average outcome trends downward. The operator can survive your wins because the operator is feeding on your future losses. In investing, the goal is to buy assets that have an expected pathway to higher value over time, driven by productive activity. The advantage is supposed to come from analysis, from time, from ownership, and from capturing growth in cash flows or economic value. Yes, markets are uncertain. No, you do not get a guarantee, but gambling is about the next outcome. Investment is about the ownership of a business, an asset, or a claim that can compound. Here is the problem in 2026. Social media has turned every form of uncertainty into content. People are no longer trained to understand probabilities. They are trained to chase narratives. When AI makes coding jobs shrink and churn increases, when layoffs hit industries that used to feel stable, people get desperate for a quick bridge. Then they stumble into signals. They stumble into systems. They stumble into community trades. They act like participation itself is proof that the strategy must work. So let's talk about the most important word in finance: expected value. If a game offers you a slight disadvantage that you don't notice, you will pay it slowly. That is the genius. They don't take your money all at once. They take it over months and years, and you keep thinking your next try will fix it. That is why the difference between "I lost once" and "I lost because the game is negative" is what matters. Now connect that to what's happening in the real economy. The Federal Reserve can push interest rates up or down, and the headline will say inflation is cooling, or growth is stabilizing, or we are near a neutral stance. But for normal people, the lived reality is different. Purchasing power can be damaged for years even after rates stabilize. Rent keeps rising. Insurance can double in a bad climate region because insurers are exiting unprofitable markets. Grocery bills don't care what the CPI chart looks like. Your paycheck buys less than it did in 2019. So what do people do when purchasing power declines? They take risk. They move savings into assets that feel like protection. They buy whatever has the loudest promise. Then they panic when the asset moves against them. They sell at the worst moment because the fear feels immediate and the logic feels optional. That is gambling behavior wearing an investing costume. Now let's make it personal with a micro story. In Las Vegas, a woman worked as a server. She hit a jackpot worth roughly $34.9 million. It sounded like freedom. It sounded like an escape hatch from wage labor. Then life did what life always does. 9 weeks later, she was involved in a serious car accident that left her with paralysis. This story is tragic, but it also exposes something. Luck does not protect you from the structure of the system. Luck cannot make your life deterministic. If you hit big but you have no buffer, no plan, and no long-term framework, you can still lose your stability fast. People hear that story and think the lesson is never count on luck. But the real lesson is colder. Even luck can be consumed by reality. In markets, the version of that is the investor who wins by accident, then assumes the accident was skill. That person becomes addicted to the feeling of control. The system loves them. Because eventually the structure catches up. Now bring this back to 2026 and the AI disruption that keeps taking the middle layer out of jobs. The old middle class was built on a predictable pathway. Education, then entry-level job, then promotion, then stability. AI changes that pathway by doing tasks cheaper and faster than humans, especially routine cognitive work. When that pathway breaks, people don't just lose income, they lose confidence in the future. They become more likely to chase quick upside because slow compounding feels like waiting for a bus that will never arrive. This is how a gambling mindset grows, not because you are dumb, because you are under pressure. And the moment you feel under pressure, you are easier to manipulate. Here is where the story gets uglier. The market is not just a neutral arena where smart people win and others lose. It is an ecosystem with intermediaries, with fees, with funding structures, with incentives. You think you are choosing between two games on the street, but sometimes you are not choosing at all. You are being steered into the game that makes someone else money. And in 2026, the steering gets more sophisticated. Cryptocurrency was supposed to be freedom from banks. Decentralization promised that retail investors would be early owners of a new system. But in 2026, institutional control is tighter than the hype era could admit. Regulation tightened the rails. Custody and compliance concentrated power. Many retail investors ended up as liquidity providers to institutions that can manage exposure, hedge, and move capital at a scale most individuals cannot match. So you get the same feeling as the left stall, higher payout promises, big excitement. Then over time the structure bleeds you. Banks own more crypto-related infrastructure than retail owns. Market makers profit from spreads and volatility. And when retail gets scared, their exits become someone else's entries. That does not mean every crypto move is gambling. But it does mean the freedom story was incomplete. The business model matters. This is the same mechanism as roulette, where the house has the advantage. It's also the same mechanism as certain trading platforms that optimize for engagement, not for your long-term outcomes. Now, you might be asking, if investment is better, why do so many people still lose? Because the word investment has been abused. People invest when they do research, when they understand a company's cash flows, when they accept volatility as part of ownership, when they can hold through downturns. Most people do not do that. Most people buy because a stock chart looked good last week. Most people buy because someone online said the story made sense. Most people sell because they panic. That is not investing. That is gambling with better vocabulary. Charlie Munger said something that still stings because it is so accurate. He compared the trading of many individual investors to gambling, not because individual investors are evil, but because they do not study the underlying business. They chase price movement. They chase the next signal. They treat the market like a slot machine with a ticker symbol. And here is the part nobody wants to say. When you don't know what you own, you don't have the right to be surprised by what you feel. So let's go deeper into the psychology of stopping at the right time, because this is where the operator really wins. A casino does not fear gamblers who are happy to sit and press their luck. Those people will lose, but they keep showing up because they think it will change. What the casino really fears is someone who knows when to stop. Someone who understands the expected value is negative and refuses to keep paying. That is why gambling laws exist, and that is why casino marketing is built around persistence. Now translate that into investing. If you have a strategy, you can stop when your thesis changes or when risk exceeds your tolerance. You can rebalance rationally. But most retail investors don't have a strategy, they have a feeling. And feelings are designed to evolve with whatever content you consume. In 2026, the content never stops, it is constant. Your feed is a slot machine. Every day, a new crisis story appears. Every day, a new AI breakout, or housing crash imminent, or crypto revolution theme pops up, and the feed knows you will react. That reaction is the fuel. So here is an open loop. I want to come back to a specific market crash fear pattern later, because it will explain why the smartest investors often look wrong while everyone else is panicking. Now let's talk about why emotion is so dangerous when your real-world life depends on money. Picture a 32-year-old nurse named David. He works long shifts. He has student debt. He rents an apartment where the landlord raises rent every year like it is seasonal maintenance. David is not lazy. David is not stupid. David is just tired. And when inflation eats his paycheck and the building's insurance rates rise because of local climate disruptions, he starts doing the only thing he thinks will help. He searches for growth. He finds a video promising that an AI revolution will make certain stocks explode. The video makes it sound like a certainty. So David buys a stock because it feels like a ticket out of rent dependence. Then the price dips. Not a collapse, just a dip. But David already feels the stress of bills. The dip becomes a threat, not a movement. He sees red and his mind goes blank. He sells to stop the pain. And the painful part is this. If David had held long enough for the underlying business value to express itself, he might have been fine. But he did not have the patience. He did not have the understanding. He had the fear. That is gambling under emotional pressure. Now imagine that pressure applied to a market where AI is already changing job composition, where unemployment can rise quietly in some sectors while headlines stay calm, where interest rate decisions by the Federal Reserve shift borrowing costs, mortgage pricing, and corporate refinancing. In that environment, volatility is not random. It is policy transmission plus economic stress plus human behavior. So the investor who thinks the market will always recover is relying on hope. The gambler relies on hope too. The real difference is whether your plan survives a bad stretch without forcing you to sell. That brings us to the Federal Reserve again, because it is the lever behind so many ordinary people's suffering. When the Fed raises interest rates, it makes borrowing more expensive. It hits mortgages. It hits credit cards. It hits business loans. It slows economic momentum. When the Fed cuts rates, people celebrate, but sometimes the damage has already been done. Purchasing power losses do not reverse automatically. Housing does not instantly become affordable. Wage growth may not catch up to price inflation. Supply constraints in housing can be long-lived, so you get a strange contradiction. You see markets recover and index numbers climb. Meanwhile, your local rent is still rising, your grocery bills are still heavy, and your emergency fund still feels like a fantasy. This is how wealth inequality accelerates. The assets the rich own tend to be the assets that rebound first or rebound hardest. The rich borrow against their assets. They can manage through volatility, the rest of you can't. And when the top 1% controls more wealth than ever, the market highs do not reflect your personal reality. They reflect someone else's balance sheet. So you ask, is the market rigged? Not in the cartoon villain way. It is rigged through incentives and structure. It is rigged through information asymmetry. It is rigged through liquidity, through leverage, through who can afford to hold through downturns. Leverage is a weapon. The wealthy can use it carefully. The average investor uses it recklessly, usually through margin accounts or through concentrated positions. And then, when volatility hits, they get forced out. Forced selling is the casino's dream in markets. It creates liquidity for the buyers who can wait. Now, let's talk about value investing, because it is often misunderstood. Value investing is not buying something cheap just because it looks cheap. It is buying something where the market price is below what the business is reasonably worth, based on cash flows, assets, and competitive dynamics. So when the market panics, the value investor does not celebrate. They analyze. They ask, has the business fundamentally changed, or is this just fear compressing prices? In 2020, early pandemic panic caused enormous price moves. Many quality stocks fell sharply, even those that would survive and eventually grow. For example, Apple's price dropped from around $80 in early highs to about $55 in mid-February, then down near the low around 60, before recovering dramatically later. If you were investing based on understanding a company's underlying value and staying disciplined, the volatility became an opportunity. If you were gambling based on short-term charts and headlines, the same drop would have forced you to sell. So the difference is not the market move. The difference is whether you treat price changes as information that can be processed or as a verdict on your life. That is why investment requires a skill set. It is not just believe in the long term, it is the ability to read financial statements, understand business models, and estimate how cash flows evolve. In 2017, the way you would learn was mostly books, seminars, and slow research. In 2026, the way you would learn is also AI tools, but the danger is that people use AI to generate persuasion, not to generate understanding. An AI can summarize a company. It cannot replace judgment about competitive moats and management quality. It cannot guarantee that your thesis is right. So you still have to do the hard work. Now let's do a pattern interrupt. Because if you keep going the same way, your brain will start rationalizing again. You have seen the charts, you have seen the stories, you have seen people who got rich quick, and the comments were full of people begging for a repeat. In January 2021, a meme stock surge hit GameStop. Retail investors coordinated in online forums. The price rose from roughly $20 to as high as about $483 in a short period. A lot of buyers chased the momentum. They assumed the crowd was permanent. They assumed the squeeze would keep going forever. Then reality returned. When the frenzy ended, the price fell rapidly back to around $40. The lesson is not meme stocks bad. The lesson is the mechanism. When your strategy depends on crowd momentum, the moment the crowd changes, your expected outcome flips. This is gambling, even if it is popular. Popularity is not value. Momentum is not business performance. Now add AI to that. In 2026, AI can amplify narratives faster than any human forum could. It can generate synthetic enthusiasm. It can spread insider claims. It can make chaos look like a plan, so the operator's advantage becomes stronger because attention becomes a commodity. Now, a second cliffhanger into something darker: quantitative investing. People assume that quantitative strategies are inherently smarter because they use math, but math does not eliminate risk, it packages it. Many quantitative hedge funds use models that trade frequently and rely on leverage to scale results. In normal markets, the strategy can look brilliant. In stress events, models can break because correlations shift, liquidity disappears, and leverage forces deleveraging. One famous example is long-term capital management, often shortened to LTCM. It was formed by individuals with major academic credentials and strong track records. They used complex models and high leverage. In 1998, during the Russian financial crisis and broader market stress, their models failed to perform as expected. The firm lost around $4.6 billion. It did not fail quietly. It required intervention by major financial institutions, coordinated with central banking support. The lesson for you is not to memorize the acronym. The lesson is that even the smartest models can be wrong when reality changes. So when someone tells you their algorithm is a solution to uncertainty, ask what happens under stress. Gambling is uncertainty with entertainment value. Investing is uncertainty with a thesis. Quant strategies are often gambling dressed as finance, especially when leverage turns small expected edge into catastrophic downside. Now here is where investment and gambling finally become comparable in a way that matters. Both can involve buying and selling. Both can involve speculation. Both can involve short time horizons. The difference is what you are betting on. Investing bets on business fundamentals, industry structure, and economic reality. You care about cash flows, customer behavior, management execution, and competitive dynamics. Gambling bets on randomness and sequence. It cares about the next card, the next number, the next candle, the next headline. Investment tries to answer the question, what is this asset worth and why? Gambling tries to answer the question, what will the price do next? That sounds similar until you meet a bear market and your life savings is on the line. Now, let's bring in a specific comparison with real numbers, because abstractions won't save you when panic hits. Imagine you have $10,000. Option 1 is a casino bet where your probability of winning is fixed and the payout structure is negative in the long run. Your expected value trends against you. You might win a few times, but the math takes its payment later. Option 2 is buying a business you research deeply. It has a chance to grow revenue, expand margins, and return cash to shareholders. It can survive shocks and compound. Say you invested in a company like Amazon in the year 2010 and held through 2020.